ounces each. So on that definition, which should be the correct definition of unallocated, we would not be unsecured creditors. We would be secured creditors because we've got 200 ounces of gold. So that type of unallocated purchase is perfectly fine, and it's the sort of system which is run by goldmoney.com. And they have it audited to make sure that the amount of gold and silver they've sold equals the amount in the vault. Then we come to the rather dubious and unscrupulous definition of unallocated, which is where it may not actually exist at all. It's that unallocated. There's no guarantee of any backing. And you'll see statements like the purchase is backed by the general assets of the dealer, or the purchase is backed as from a claim against the inventory of the dealer. Well, that is no guarantee that there is anything to back your purchase. They may only have 1 ton of gold in stock, and maybe you bought 5 tons. Well, yes, you have a claim against their stock, but their stock is not big enough for your purchase. So
they're simply naked longs.
That's right. So they're selling you an IOU. And in fact, if you look on the LBMA website, for the unallocated account, they say that the transactions in the account will be dealt with as debits and credits to the account, and the overall balance of the account represents the indebtedness between the two parties. Well, you don't want an investment in gold and silver which is a debt, which is a security risk, a credit risk of the bullion dealer. You buy, or at least most people buy gold and silver for safety, for avoiding credit risk.
A hard asset.
A hard asset. So this is the last thing you want to see as a definition of your account. So that's the LBMA. The LBMA states this, that you're an unsecured creditor. It doesn't state that your account is 100% backed. And there are other vendors out there for the retail space who do a similar sort of thing. And their language mirrors some of the language of the LBMA, where they say that you have a claim against a pool of precious metals, or you are an unsecured creditor, or your investment is backed by the assets of the dealer. All these sorts of phrases, which means that the investor really has to do some due diligence and read very carefully the terms and conditions of what he's buying, to make sure that there is the language there that guarantees that if you buy 10 ounces of gold, they're actually putting 10 ounces of gold aside for you. It may be unallocated in that you don't get serial numbers, but it is 100% there. And this is a very important point, because not only will the investor perhaps suffer financially, but his investment is not going to contribute to what he wants, which is an appreciation of the value of his asset. Because if that asset is not purchased and taken off the market, the price can't possibly go up. So he becomes part of the problem that we're talking about, the suppression of the price of precious metals, instead of part of the solution, which is having that safety of an investment, and an investment which will appreciate against fiat currencies. So it's these unallocated accounts where they are fractional reserve processes means that your precious metals are essentially a mirror of the fiat money system. That the price is suppressed because precious metals can be created out of thin air by just giving you a certificate or a piece of paper that says you have 100 ounces in a vault when it doesn't exist. It's the same way as dollars and euros or anything else is created out of thin air. And most investors are buying precious metals to get away from that system. They don't want to hold something that is meant to store wealth that can be created out of thin air.
Now, I was following your line of reasoning in that article, and then also combining that with what Jeffrey Christian of the CPM Group said about the bullion banks being leveraged somewhere around 100 to 1. So let me play devil's advocate here. Why should the holders of bullion in the allocated accounts feel any safer about their own bullion? In other words, while the bullion banks can't allocate the same bullion to more than one party, what is to stop them from selling the same allocated bullion to 100 other unallocated buyers?
Well, that's a good question. It then comes down to integrity and honesty. Now, of course, some of these bullion deals will allow the holding to be audited. So you could go in there and check that your holding is there and that the serial numbers are correct. So I think from a safety point of view, there is less risk from that point, from that issue. I think
it's a better. Sorry.
So if you've got an allocated account and you've got serial numbers, you can be fairly sure, especially if you go and audit it, that your investment is there. The real issue is this unallocated account, and I haven't heard of anybody who's had issues with allocated accounts. The main issue is with the unallocated accounts, and as I say, the language of the contracts, the way they describe what you're buying, is leaving the door open for that type of dishonesty, selling you something which doesn't exist. So my concern is really with the unallocated accounts.
Right. Now, in the King interview, you famously remarked that the bullion fraud of the bullion banks could end up as the largest fraud in financial history. Now, given that these multinational bullion banks have apparently leveraged their bullion to such an extreme, and thus cheated investors to such an extreme, is there any way to restore credibility to the purported bullion sold by these bullion banks other than a global simultaneous audit of all their bullion accounts and custodian agreements?
Well, the reason I said it could possibly be the biggest financial fraud in history is just by the numbers I gave you earlier. Those levels of trade being on a net basis $6.3 trillion. We're talking about something which is a fractional reserve on trillions of dollars. So, that certainly puts the Madoff scandal into the chump change category. So it's on that basis that I say that. But
would it be the starting? Sorry.
So how would it be resolved?
Yeah, the starting point for fixing a problem of this magnitude. Where would you begin to dig into something like this?
The problem is obviously very difficult to fix if it's as extreme as I believe it to be. I suspect that it will actually be fixed by market forces, that investors will, from what we've exposed, start to be more wary of what they're purchasing and will insist on physical bullion. Either in allocated accounts or for them taking delivery or whatever they want to do. So that will impose a discipline on these dealers when they don't have enough bullion to meet the demand.
So instead of fixing the market from an auditing standpoint, you're more expecting it to be resolved through a default event.
Yes, I mean, if you look at history, I mean, how many cases has any problem like this ever been resolved by the regulators or somebody coming in and nipping it in the bud? I can't think of a case. It usually has to blow up. A classic example of the Madoff affair or Enron or Fannie Mae, Freddie Mac. All these problems that we've had, they all have to blow up before the problem is exposed. So I really can't think there'll be a difference in this case, that there'll be proactive attempts by regulators to solve this. I just don't think that's going to happen. And also, I think it's far too big for them to handle, because whatever they do, it's going to make the precious metals prices multiples of what they are today, when it becomes clear how little there is and how much has actually been sold.
You can't fix 100 to 1 leverage.
Not quietly.